Before the crash of 1929, Americans believed they had cracked the code of endless prosperity. The stock market wasn't just rising, it was soaring at a pace that seemed to defy gravity and doubt alike. Ordinary people, not just Wall Street insiders, were pouring their life savings, mortgaging their homes, borrowing on margin to buy shares in companies whose fundamentals they barely understood. The newspapers called it the age of scientific capitalism, a new era where the old rules of boom and bust no longer applied. The market was a machine of infinite wealth creation, and everyone who wasn't in it was a fool. Businessmen wrote books with titles like Everybody Ought to Be Rich, arguing that anyone could become a millionaire in 5 years if they just invested in the market wisely. Magazine articles proclaimed that the country had entered a permanent plateau of prosperity, that the business cycle had been defeated, that recessions were now things of the past, artifacts of a less sophisticated era. What people didn't see, what they refused to see, was that the night before the crash was the most dangerous moment of all. Not because the fall was sudden, but because everyone was certain it would never come. That certainty, that universal agreement that nothing could go wrong, was itself the red flag that nobody wanted to notice. The 1920s roared because Americans believed in a lie that felt like truth. After World War I ended, the country was exhausted and broke, mortgaged to its eyeballs to European creditors who owed war debts they would never repay. The government raised tariffs, effectively defaulting on those debts by cutting off the Europeans' ability to export and earn dollars to pay back the United States. So American banks flooded with capital that had nowhere to go except inward. Money that needed returns and had nowhere to deploy itself but the stock market. Enter the stock market, and with it, the fever that would grip the nation for the next decade. What had once been a place for the wealthy and well-connected to buy pieces of railroad companies and steel mills transformed into a national fever dream. The transformation happened gradually at first, then suddenly. Stock prices began climbing in 1925 after years of relative stability. They climbed because people expected them to keep climbing. It sounds circular because it was circular, the very definition of a speculative bubble. The more people bought, the higher prices went. The higher prices went, the more people wanted to buy, because now there was a fear of missing out, a gnawing sense that everyone else was getting rich and only fools were standing aside. A share of General Electric that had traded for $40 in 1920 was worth $90 by 1929. Radio stocks multiplied tenfold. Radio Corporation of America rocketing from $12 to $505 in just a few years. Utilities that paid modest dividends were bid up to prices that implied the company would have to sell infinite electricity forever to justify the valuation. Speculators, and by 1929 nearly everyone was a speculator, did not care about profits, cash flows, earnings per share, or any of the traditional metrics of value. They cared about one thing and one thing only, the trend. And the trend was up, relentlessly and mercilessly up, seeming to have no end in sight. Here is where the psychology becomes important. Crowds don't think rationally, they feel. And in the late 1920s, the crowd felt like geniuses, like they had finally figured out the great secret of wealth creation. Radio and automobiles were genuinely revolutionary technologies that reshaped how people lived. The assembly line had dramatically lowered production costs and made consumer goods affordable to millions of working-class people for the first time in history. A Model T Ford cost less than it had cost 5 years before, even as wages crept up. Productivity was genuinely up. Wages for many were higher than they had been. Electric power was spreading into homes and factories at a rapid pace, transforming work and leisure. These were real trends. These were genuine innovations. The pessimists who warned about overvaluation could point to the fact that the stock market was overvalued. End to real improvements in productivity and quality of life. But here is the crucial bit. They were not infinite trends. Eventually, everyone who wanted a radio had a radio, and then the market would saturate. Eventually, every household that could afford a Model T Ford had bought one, and then growth would plateau. Eventually, the growth would slow, stabilize, mature, and normal market conditions would return. But that eventually was treated as a theoretical point in a distant future that would never quite arrive. Something for future generations to worry about, not for investors who were making money right now. The banks and brokers did everything they could to fuel the machine because they made extraordinary money from the engine of speculation. They had every incentive to keep the game going. Brokers charged commissions on every trade, which meant they had a vested interest in rapid turnover, not careful analysis or the boring advice to buy and hold. The more people traded, the more money the brokers made. Investment trusts, the hedge funds of that era, sprung up by the thousands, many of them leveraged to the hilt, meaning they borrowed money to amplify their bets on already rising stocks. Trust management became a way to extract fees while taking zero responsibility for losses. By 1929, investors could buy stocks on margin, putting down just 10% of the purchase price and borrowing the rest from their broker. This meant that for every dollar an investor had, they could control $10 worth of stock. If the stock went up 10%, they made 100% return. If the stock fell 10%, they were wiped out completely. The math was ruthless, but the psychology was seductive. And yet this leverage was sold to ordinary people not as a catastrophic risk, but as the key to wealth, as the rational way to play the market in this new scientific age where the old rules supposedly no longer applied. Brokers encouraged it. Advertisements boasted of the fortunes to be made. Loans were easy to obtain. Collateral was minimal. The barrier to entry was lower than ever before, which meant that people who had no business being in the stock market at all were being welcomed in with open arms. The numbers were staggering. By 1929, more than 4 million Americans held active brokerage accounts. That might not sound like much today, but in a country of 130 million people, where fewer than 1 in 10 households owned significant assets, this was extraordinary. Participation had tripled in just 5 years. People who had never bought a stock before were pooling money with neighbors to speculate together in investment clubs, some of them managed by people with no investing experience whatsoever. Shoeshine boys were offering stock tips to their customers, confidently recommending specific companies as if they had done rigorous analysis rather than simply repeating what they had heard on the street. Taxi drivers were discussing the market not as speculators but as experts, offering advice to passengers about which stocks to buy. A banker later recalled that his maid had asked for investment advice, and when he warned her about the risks, she looked at him like he was insane, like he was missing the obvious truth that only fools and cowards were not in the market. How could you warn about risk when the trend was so clearly up? How could you explain that valuations were disconnected from fundamentals when everyone around you was making money? How could you not see that the old rules of risk and return no longer applied in this new age of scientific capitalism? The warnings came. They were ignored. The Federal Reserve, then run by Benjamin Strong before his death and picked up afterward by others who shared his faith in the market, warned about excessive speculation. They fretted about the volume of margin buying, about valuations that bore no relationship to earnings, about the concentration of risk in over-leveraged investment trusts. But the warnings were gentle, almost apologetic. No one wanted to be blamed for killing the golden goose, for stopping the greatest wealth creation machine in history. Politicians were terrified that raising interest rates or tightening credit might slow the economy or dampen the market. The president, Calvin Coolidge, had famously declared that the business of America is business, and by extension, the business of government was to stay out of the way and let markets work. His successor, Herbert Hoover, believed in the self-regulating market, in the idea that free markets always find the right price, and that government intervention would only make things worse. Some warnings came from academic corners, from economists who had studied previous manias and understood the patterns. But academics are almost never heeded by crowds in the grip of profit fever, especially when their warnings contradict the lived experience of ordinary people who are literally getting richer every day that the market rises. By October 1929, stock prices had become so detached from reality that any structural crack could trigger a collapse. The foundations were rotting beneath the surface, even as the skyscraper rose higher. Margin calls were beginning to mount, as investors who had borrowed to buy stocks at the peaks found themselves facing demands for more collateral. Some companies were being exposed as worth far less than their stock prices reflected, shell companies or frauds that had been bid up on momentum alone. A few wealthy investors, people with inside information, or simply possessing the rarer gift of skepticism in an age of euphoria, began to quietly sell, taking their profits and moving to the sidelines. In late September and early October, the market stumbled. Not crashed, just stumbled. Some heavy volume showed up on certain days. Some profit-taking by retail investors who decided to lock in gains. Nothing that would alarm a rational person who believed in the long-term fundamentals of the American economy. But the stumble was the warning, the canary in the coal mine, the first crack in the dam. But on October 23rd and 24th, 1929, the market began to show signs of true stress that would not go away. 3 million shares changed hands on October 24th alone, a volume that threatened to overwhelm the back-office systems of brokerages that still relied on clerks, paper, and hand calculations to track transactions. The machinery that had seemed so robust suddenly appeared fragile, unable to keep pace with the selling pressure. Prices were falling, and as they fell, margin calls went out to investors who had borrowed to buy stocks. These investors, Many of them ordinary people who had put their life savings and more into the market, had to sell to raise cash to meet the margin calls, which drove prices down further, triggering more margin calls in a vicious spiral that fed upon itself. The reality of leverage finally became apparent to those who had been seduced by its promises. What goes up on leverage can come down twice as fast, can go negative, can destroy not just gains but capital and credit alike. October 28th was the first true catastrophe day, a day that would go down in history as Black Monday. 16 million shares were traded, a record that would stand for 25 years. The ticker machines that printed stock prices literally could not keep up with the volume. By the time a stock price printed on the tape, minutes or hours had passed. The price was ancient history by the time an investor saw it. By the time prices printed, they were already obsolete. Investors who thought they were selling at $30 a share discovered they had actually sold at $15. Orders to sell piled up in a logjam that brokerages could not process. Panic was spreading like a contagion through every financial center in America. Brokers, frantically trying to meet their own obligations to their own creditors, began refusing to take new orders. The telephone lines connecting brokers to customers became so overloaded that some investors could not reach their brokers to sell even if they wanted to. You could have all the shares in the world and still lose everything if you could not reach a broker to sell them. Men who had been millionaires on paper the week before were now bankrupt, and they often did not even know it yet because they could not get through to find out, because the communication infrastructure itself had collapsed under the weight of the disaster. October 29th was the day the market broke completely. 12 million shares traded, even more than the day before, and the system was nearing the point of total failure. The weight of selling pressure was so immense that it seemed the entire system might simply collapse into incoherence. There was no bid-ask spread anymore, no price discovery mechanism. There was only panic. The ticker ran 2.5 hours late, machines continuing to work long after the exchange had closed because they could not keep up with the orders from earlier in the day. Investors standing outside brokerages in cities across the country watched the mechanical ticker slowly print prices that seemed to bear no relation to the bids they could see on the exchange floor or that they remembered from hours earlier. The feeling was of being trapped in a nightmare where reality itself was incoherent. Suicides began that night. Men who had gambled away their life savings and borrowed fortunes on margin walked into rivers or jumped from office windows. In New York, families woke to reports of bodies pulled from the Hudson. The newspapers the next day ran headlines that were almost comically severe in their understatement. One read simply, "Crash." Another, "Stock prices in headlong panic." A third, from a conservative paper, "Billions lost." The reality was far worse than the headlines could capture, a societal catastrophe unfolding in real time, destroying fortunes and lives simultaneously. The psychological terror was the cruelest part. On October 25th, after 3 days of catastrophe that had wiped out fortunes and destroyed confidence, the market rallied sharply. Maybe the worst was over. Maybe this was a buying opportunity, a chance to buy the dip at lower prices and recover losses. Men who had lived through the first 3 days of selling, who had felt the sickening sensation of watching their wealth evaporate, rushed back in to buy. They placed orders, hoping to catch the falling knife, to recover something from the wreckage, and the market surged higher, climbing back toward previous levels. Hope flickered back to life. For a brief moment, the fever dream returned. Perhaps this would be like 1907, another scare that would blow over given a few weeks of time. Perhaps the authorities would step in and stabilize things. Perhaps it had all been just an overreaction by panicked novices. Instead, the market continued lower, eventually plunging past the lows of the previous days and establishing new low points. The investors who had bought the rally found themselves trapped, having bought near the top of the relief bounce. The rally was a trap, a final luring in of remaining capital and remaining hope before the deeper capitulation began. What made the crash particularly terrifying was that most people did not understand how much money they had lost because the accounting was incomprehensible to them. A man who had $50,000 saved up but bought on margin, putting down $50,000 and borrowing another $50,000 to control $100,000 worth of stock, thought he was worth $100,000. His neighbors were impressed. He was a winner in the great game of capitalism. When the market fell by half, 50%, he thought he still had $50,000 left, that he had broken even. In reality, he had negative $50,000 in debt. His broker now owed him $50,000, and his $50,000 in savings was gone. The math was simple, but the psychology of it was brutal. You could lose more than you owned. You could end up owing money while seeing your investment shrink to zero. You could be bankrupt without ever having spent the money, without having made a single mistake in judgment beyond the original sin of believing that leverage was free money. The mechanism was invisible to most people until it wasn't, and then it became crushingly clear but far too late to do anything about it. The weeks after were apocalyptic in scale and sweep. Credit lines froze as banks became terrified of losses and tightened their standards. Businesses could not borrow money to finance operations, could not get short-term loans to pay suppliers, could not maintain the basic functioning of commerce. Farmers who had bought land on credit at speculative prices suddenly found their collateral worthless and their debts still standing, still demanding payment. Construction ground to a halt overnight. Building projects were abandoned mid-construction. Factories began laying off workers by the thousands. The unemployment rate, which had been 3% in 1929, reached 25% by 1933. 1 in 4 people unable to find work. Soup lines stretched for blocks in every major city. Families were evicted from homes, their belongings thrown into the street. Bread lines became the most recognizable symbol of America in the early 1930s, a vision of a great nation brought low by the destruction of wealth and confidence. But here is what's darkest about the crash. It did not have to happen this way, and that's what makes it so tragic. There were moments when a different policy choice would have prevented the worst of the catastrophe. The Federal Reserve could have printed money aggressively in November and December of 1929 to increase liquidity and stop the cascading margin calls and defaults. They could have acted as a lender of last resort, providing money to banks to prevent them from failing. Countries that did this, like Sweden and some other nations, weathered the crash better and emerged from the Depression earlier than the United States. Instead, the Federal Reserve followed the orthodox economic advice of the time, advice that sounds insane in retrospect, but seemed reasonable given the intellectual framework of the era. During a crisis, you must restrict credit and maintain the gold standards discipline. You must not coddle speculators. You must let the system purge itself of excesses. The money supply actually contracted when it should have expanded. Credit dried up when businesses needed it most. The crash was allowed to trigger a systemic collapse that transformed what might have been a nasty recession into the Great Depression. This is the part that echoes most painfully into our time. The crash of 1929 was not just a market correction or a natural recalibration of prices that had gotten too high. It was a policy-induced catastrophe layered on top of a market mania driven by speculation and cheap credit. The mania was the fault of speculators and loose credit conditions that made leverage too accessible. The catastrophe was the fault of wrong choices made by the people who controlled the levers of power, who failed to act when action could have limited the damage. They chose orthodoxy over pragmatism. They chose ideology over empirical observation. They chose to let the system purge itself of excesses rather than to step in and prevent systemic failure. And the ordinary people paid with their homes, their jobs, and their lives. The wealthy and well-connected found ways to protect themselves. The ordinary person with limited resources and no connections or inside information was destroyed. The warning signs before the crash are almost embarrassing in their obviousness to modern observers looking back with hindsight. Valuations were insane by any reasonable metric. Leverage was extreme and dangerous. The masses were in the market at the peak, just as they bought real estate at the peak in 2007 and cryptocurrencies at the peak in 2017. The sentiment was euphoric and dismissive of anyone who sounded alarms. Warnings from intelligent observers, serious people who had studied economics or history, were dismissed as jealous, out of touch, or lacking the vision to understand the new era. Everyone believed that this time is different, that the old rules no longer applied, that we had entered a new era of scientific capitalism where crashes could not happen. This is the eternal pattern of speculation. The specifics change. The asset is stocks in 1929, then real estate in 2007, then cryptocurrencies in 2017, then tech stocks in 2021, but the underlying human psychology remains frozen in place, unchanged by history, repeating the same mistakes with different names. What happened after 1929 shaped the world for nearly a century in ways both obvious and subtle. The crash destroyed confidence in markets and led to the Great Depression, which in turn created political instability and desperation that allowed fascism to rise in Europe. Unemployment and despair created a vacuum that extremist movements filled. The war that followed killed tens of millions of people and reshaped the entire global order. The regulatory regime that emerged in response, the Securities Exchange Act, the creation of the SEC, rules against naked short selling, margin requirements, circuit breakers. These reforms were written in blood and took decades to fully implement. People had to lose nearly everything before society agreed to enforce any rules on the market at all. And even then, and the regulations were fought by those who profited from excess and opacity. Yet the same patterns repeat with remarkable consistency. In 1987, the stock market crashed again, Black Monday returned in a new form, and the Federal Reserve had to print money aggressively to prevent a depression. The lessons of 1929 had finally been learned by policymakers, and the response was swift and decisive. In 2000, the tech bubble burst, and again, the Fed eased monetary policy to prevent cascading failures that might have spiraled into systemic collapse. In 2008, the financial system nearly collapsed when the housing bubble burst and subprime lending disasters triggered a credit crisis. And again, extraordinary measures were required: Federal Reserve liquidity, stimulus spending, bank bailouts, to prevent a 1929-style catastrophe from unfolding. Each time, people claimed that the time was different, that structural changes in regulations or technology or markets had prevented the old patterns from recurring. Each time, human nature and the profit motive proved more powerful than regulation and institutions, returning to old patterns as soon as the memory of the last crisis faded. The deeper lesson is not about the market itself, or about stocks or technology or any particular asset class. It is about the human tendency to become irrational at scale, to follow the crowd even when the crowd is walking off a cliff. When crowds believe that money can be created from nothing, when leverage is available at cheap rates with minimal scrutiny, when the question of how high can it go seems more interesting than how high is too high, the crash becomes inevitable. Not tomorrow, not next month, but eventually. You cannot call the top precisely or predict the exact moment of reversal, but you can know that bubbles eventually burst. You cannot know which asset will be destroyed next, but you can know that confidence is finite and fragile. You cannot stop speculative booms from forming because the profit motive is too strong and the allure of easy money is too seductive, but you can prepare for the inevitable collapse. The night before the crash, people were certain they were geniuses. They had discovered the secret to infinite wealth creation. They had broken the old rules about risk and return that had governed markets for centuries. They had entered a new era where the normal laws of economics no longer applied, or so they believed. Everyone who was not playing the market was a fool, was missing out, was stuck in poverty while others became rich. Everyone who was conservative with their capital was wasting their opportunity. Everyone who sounded warnings was jealous or stupid or hopelessly out of touch, unable to understand the new paradigm. This is the moment when crashes happen, not when people are fearful and cautious, when they are too confident and aggressive, not when prices are low and people are terrified of buying, when prices are high and people cannot imagine them falling further. The night before the crash is always the most dangerous night, the night of maximum confidence, because nobody in the crowd believes that a crash is possible. That certainty, that absolute certainty, is the setup for catastrophe. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.